Hello everyone, this is Terry with Futures IO, and as always, I would like to thank you for joining us today. It is my pleasure to welcome back Carley Garner from DeCarleyTrading for today's webinar, Micro E-minis are a game changer. Throughout the webinar, if you have a question, please feel free to type them into the questions box. We'll do our best to answer them at the end of the event. This webinar will be recorded and posted on the Futures.io website within 24 to 48 hours. If you're watching this afterwards on YouTube, please do us a favor and give us a thumbs up if you enjoyed the webinar. And as always, please feel free to share, comment, and subscribe to our channel. It really helps us a lot. For trading news, events, and information, follow us on Facebook, YouTube, and Twitter using @FuturesIO. And now, without further delay, I will hand it over to Carley, and you'll get the pop-up to share your screen again.
Okay.
All right, looking good. She's all yours.
Okay, perfect. So it's a pleasure to be here. Thank you for having me. Today we're going to talk about the E-micro E-mini stock index futures. Now, as we're going through this, I want to point out that they're actually the first micro contracts to come along were the currencies and gold. And people tend to forget about that, but those are great products also. The idea is these micro contracts are very small. So it gives you a way to get into the markets with a small amount of risk. It gives you a way to hedge your stock portfolio in a more exact manner, and also gives you the ability to maybe paper trade to strategy with a little bit of money on the line, a little skin in the game, so that you get some of the emotions involved, that sort of thing. So anyway, that's what we're going to talk about today. My name is Carley Garner. I am a futures and options broker and strategist with DeCarleyTrading. We're located in Las Vegas. The weather's nice here, but I know most brokers are in Chicago. We like Vegas. Anyway, if you're on social media, you can check us out on Facebook, Twitter, Instagram. If you just type in DeCarleyTrading or Carley Garner, we'll pop up. And just a little bit of background information about myself. I write a monthly column for Stocks and Commodities magazine. I also contribute content to Jim Cramer's Mad Money. In fact, we were just on last week. And I do write a couple of newsletters in-house for our brokerage clients that include trading recommendations, market commentary, that sort of thing. If you're tech savvy, we do have a mobile app. The mobile app is absolutely free to download, and most of the content is free. There's videos, news feeds, all kinds of good information on commodity trading. There is a section for restricted content, which we basically keep exclusively to our clients, but you can sign up for a trial, so if you're interested in that. But even if you never trade with us, the app is free, and I think you'd get something out of it. I've written multiple books. The two latest books are Higher Probability Commodity Trading and A Trader's First Book on Commodities. I'm in the process of writing a commodity option trading book. It's going to be similar to Commodity Options, which is the very first book I wrote, but it'll be bigger and better and updated, of course. So anyway, let's get started. There is a substantial risk of trading futures and options. In fact, even though we're talking about micro contracts and the risk is lower, it still exists. We're not investing, we're not guaranteed to make money, we're trying to beat the markets, and it can be very difficult at times. So I assume a lot of you are stock traders, not necessarily futures traders. So before we get into the details of the E-minis, I just want to talk about why it might be a good idea to at least consider trading futures. And when I say futures, I'm talking about futures contracts as well as options on futures. So if I say futures or commodities, this is what I'm talking about, options and futures. So traders tend to flock towards what is familiar, and that's stocks and ETFs, mostly because most people already have a stock account open. So it's really easy to start trading actively in your stock account. And some of your stockbrokers even offer futures as kind of a side product. But I can tell you, if you're trading futures with a stockbroker, you're probably not getting what you need out of it. You're probably not in the right environment. And the reason being, it's like going to a Chinese restaurant and ordering a hamburger. It's going to look like a hamburger. It might even taste somewhat like a hamburger, but it's not going to be what you wanted. It's the same idea. Stockbrokers offer futures on the side, but it's not what they do. It's not what they're good at. So with that said, if you're trading ETFs and leveraged ETFs, you should really take a hard look at futures because a lot of the ETFs are constructed in a way to basically mimic futures markets, especially if we're talking about things like gold and GLD or UNG ETF. Those type of things are actually taking investor money, pooling it, and then going to the futures markets and buying it. So you can just imagine how inefficient that is. They have to rebalance, they have to pay management fees. There's all kinds of things going on that interfere with you speculating correctly on the price of crude oil or natural gas or gold, whatever it is, and not actually getting your money's worth. So the great thing about futures trading is you will have around-the-clock access. So if you're trading gold futures, S&P futures, which are what we're going to talk about today, crude oil, 23 hours a day. So along with 23 hours a day in market access, and by the way, they're liquid 23 hours a day. We're not talking about after-hours trading where the bid-ask spread is wide and you can trade if you want, but you're going to get hammered on the spread. It's not like that. It's liquid. If you want to trade, even in the options markets, for the most part, the bid-ask spread is usually a couple ticks. There's great market makers. So again, nothing can stop you from trading around the clock. There's also free leverage and a free margin account. All accounts on the futures side of things are granted portfolio margining. That means if you go along a futures contract and you sell a call against it, you get a margin discount. If you buy the S&P and sell the NASDAQ, you're going to get a margin discount. That's not the case in most stock portfolios. Most stock portfolios, you have to apply for portfolio margining and you have to have a big account to do it. In futures, as long as your account's open, you get portfolio margining, and most brokerages will allow you to open with a couple $1,000s. Not necessarily recommending you do that, but you can. Also, in the futures markets, you can buy or sell in any order without any additional restrictions. There's no day trading rules. There's no uptick rules. You don't have to borrow shares and pay interest. If you want to go short, you sell. If you want to go long, you buy. So we already mentioned that a stockbroker generally will require you have a big account. It's usually 100,000 or more to trade on leverage. In futures, again, like I mentioned, you can trade with as little as a couple $1,000s. Also, in futures, there's a level playing field. Orders are generally filled on a first come, first served basis. There's no special treatment if you're trading one lot or if you're trading 1,000 lots. It's treated the same. That isn't necessarily always the case in the world of stock trading. And if you're like me and you pay close attention to taxes, trading futures offers a couple of benefits. You're taxed at a 60-40 blend between long-term and short-term capital gains, and you get to report one single figure to the IRS. You don't have to report every individual trade. You basically get a 1099 at the end of the year. You let them, which lets you know if you made money or lost money. You report that one number. That's it. There's no additional work involved. And also, trading futures is exciting. It's the one arena that you can truly make or lose a lot of money really quickly. Now, to make or lose a lot of money quickly, you have to approach it in that manner. What we're talking about today is not going to get anybody rich. It's not going to get anybody poor, but that's really the idea of it. We're trading futures on leverage, but we're trading it in a very small size. So it's not going to ruin anyone's life. It's not going to, change anyone's life for the better probably either, but it'll give you a way to get your foot in the door without too much stress. On a side note, just to give you an idea of what is possible in futures, I once saw a trader turn $10,000 into $500,000 in 2 weeks, and that is not an exaggeration, but unfortunately he gave it all back plus some. So that's just the type of things you can see if you're trading in that aggressive of a manner. I'm not recommending anybody do that, and he just happened to be in the right place at the right time. It was during the 2008 market crash, but just wanted to give you an idea of what can happen if everything lines up. If all the stars line up, things can get pretty wild. Okay, so what are micro E-minis? They're obviously a futures contract. We're going to talk about the stock indices today. I already mentioned there is a gold micro, and there are currency micros. Now, if you're trading with a futures broker that doesn't have access to those products, I highly recommend you start looking around, because it's really important to have access to all the products so you can speculate in the size that you need, and you can hedge if you need, and that sort of thing. So micro E-mini stock index futures were created by the CME to overcome the largest obstacle keeping retail traders from futures, and that's risk. When I tell people what I do for a living, I'm a futures broker, they all get a glazed look in their eyes, and they maybe panic a little bit, because people, when they think of futures, they think of risk, and it makes people uncomfortable. So this product, the E-mini stock index, the micro E-mini stock index futures, they bring a lot of benefits of trading futures, the ones we already talked about: 24-hour market access, leverage, all those sorts of things, to the retail trader, because it takes away a lot of the oversized risk. So it's the same leverage, but less risk in terms of dollars. And if it's less risk in terms of dollars, it's giving the trader more room for error, and therefore, in theory, it should give people a higher probability of actually making money. The E-micro stock index futures products exist for 4 major indices, and that's the S&P 500, the NASDAQ 100, the Dow Jones Industrial Average, and the Russell. There are no options written against these futures. These are they're micro futures with no options. But to be honest, they're so small that you really wouldn't want to trade options against them anyway. It would just be almost a waste of effort. And as a broker, I'm telling you this, and tell me, I'll basically just say it outright. If there were options written against these products, the only person that would benefit would be the broker, because they generate commission, and the trader really wouldn't be any better or worse off. So there are, I don't know if everybody's aware of how the notional value and stock index futures work, but to figure out how much you're trading when you trade a futures contract in the stock market, like the S&P, the NASDAQ, the Dow, the Russell, you basically take the point value and you multiply that by the value of the index. So for right now, let's just say the S&P is trading at 3,300. I know it's a little above that after today, but we'll call it 3,300 times 5. The notional value of that contract is now 16,500. I know the slide says 16,000, but this market goes up so much every day that it's hard to keep the slides up. But just to give you an idea, every micro contract that you're trading $16,500 worth of S&P allocated stock. The margin on that is roughly $700. So for $700, you're making or losing based on $16,000 worth of stock, or $16,500, whatever the S&P value is. So the NASDAQ is similar. If the NASDAQ's at 9,000, you're trading about $13,000 worth of NASDAQ stock. If the Dow is at 29,000, you're trading about $14,500 worth of Dow stock. The Russell, the nice thing about the Russell micro version is it is really small. If anybody's ever tried to trade the full-size Russell, or it's actually the mini, but people consider it full-size. If you've ever traded the traditional mini Russell, you know it moves really fast, and if you're on the wrong side of it, it can get ugly quick. So this is a really great product. If you're interested in trading basically an index that's valued based on the small cap part of the market, the Russell Micro is a great product to trade. So I'm not going to read this whole slide to you, but just to give you kind of the basics on how it works, the micro E-minis are exactly like the regular minis. So the mini Dow, the mini S&P, the mini NASDAQ, we all know that they trade quarterly, right? The futures contracts expire in March. Sorry about that. I was trying to multitask. So anyway, March, June, September, December, those are the cycles. So right now everybody's trading the March contract. The micros are going to be the same. The symbols are pretty similar. You basically just throw an M in front of the E-mini S&P symbol. So the symbol is MES, and the NASDAQ, it's M and Q. Again, not every broker is going to offer these products. Not every trading platform is going to have them. If you notice that you don't, I consider that a problem. I would probably shop for a new broker, or at least let your broker know that you would like those products added. Now, just on a side note, brokers that do offer these products do generally offer day trading margins. Now, the day trading margin on the regular E-mini S&P is usually about $500. So as you can imagine, the day trading on the micro is really small. It's about $100, I think, across most brokerage services. So you only need $100 in margin to day trade one of these things. That just kind of gives you an idea of how slow they move. That said, I don't think these are day trading vehicles. In my opinion, it's just not worth the effort. I don't know if that's the right word, but you're probably not going to make or lose enough per day to day trade these unless the market has a big day. Although recently, we've had a couple decent sized up days. It might have been worth your while as a day trader, but for the most part, you're probably just going to pay transaction costs and come out a little ahead or a little below trying to day trade these. I think these products are more inclined to swing traders or position traders or hedgers. So this chart is really just to give you an idea of how the E-mini contract relates to the micro contract, what the difference is. We've already talked about that the micro is 1/10 the size of the E-mini. So you can see this is actually from last year. This is, I know everybody's forgotten this by now because the market just does nothing but go up. We forgot what corrections were all about and what they felt like. But if you do remember way back into last year, we did have a correction. It started in October, and when I say last year, I'm saying 2018. So in 2018, from October to about Christmas Eve in December, the S&P dropped pretty sharply. If you were trading an E-mini contract, you would have made or lost 31,000. I mean, that's assuming you put the position on, you held it all the way through, and that's a big assumption. This is just an example to give you an idea. So $31,000, I think we can all agree, is a substantial amount of money to make or lose. If you were long, hopefully you didn't stay long the whole time. If you were short, I can guarantee you probably didn't stay short the entire time. You probably took profits early, and who could blame you? Or if you're using a trend trading system which trails stops, your stop was probably pretty deep, and you probably gave a lot of that back at the end. So either way, you probably didn't sell the high, you probably didn't buy the low. But just to give you an idea, an E-mini trader might have made a decent amount of money or lost a decent amount of money, but there's a good chance he probably didn't survive. I don't want to say survive, that's not the right word, but probably wasn't there in January when the market rebounded. So as a micro trader, let's say you had absolutely horrible timing and you were super stubborn and you refused to get out. If you bought the highs and you rode it all the way through, your maximum drawdown would have been about 3,000. Obviously, no one wants to lose 3,000, but we're talking about the biggest correction we've seen in a couple of years, and it was pretty quick. So maybe if you were trading a micro, instead of panicking and getting out like you would have had you been trading a mini, you might have actually even added to the contract and made some money on the way back up. So the point I'm trying to make is with the micro S&P versus an E-mini, the contract is so small you can tolerate bigger moves and you'll be more comfortable to make sound decisions. You're probably not going to be as prone to panicking, and we all know what happens when traders panic. It's the worst thing you can do. It's hard not to because we're human, and that's exactly what we're programmed to do. But panicking is the hardest thing to recover from because it generally means you're taking a big loss, and a lot of times the market move is temporary. I mean, the market looked horrible going into Christmas last year, and within a couple of months we'd recovered almost all of it. So you just never know, but usually panicking with the herd is the worst thing you can do, and trading micros is going to put you in a mindset that allows you to possibly ride some of those adverse moves out. So there's a lot of obstacles that are solved by trading the micro versus the E-mini. There's less margin required. The margin does fluctuate, but it's less than 1,000. I would say it's probably going to stay less than 1,000 for quite some time. You can hold it overnight without losing sleep. Most of us wouldn't be comfortable putting an E-mini S&P trade on and going to sleep without some sort of hedge or stop or something in place. But with a micro, you might sleep pretty well at night with one on, because you're even if the worst case scenario happens, it's probably not going to ruin your trading account or your life. It just might be annoying. But in the best case scenario, it could be a pretty stress-free gain. Also, if you've noticed, especially this week, it's been exaggerated. About 30 minutes before the close, there's been a really big short squeeze. I mean, massive short squeeze. And a lot of that is because day traders are trading on too much leverage and they don't have the margin to hold overnight. So what happens is they're forced to get out at really horrible prices before the close, and then they have to resell in the overnight or the next day, depending on what their broker allows them to do. If you're holding a micro contract, you don't have to worry about all that chaos that happens on the close, the premature stop outs, the squeezing out, all those sorts of things. You just kind of, if you still are comfortable with your position, you still like it, you just hold on for the ride. The micros also give you lasting power. Again, I mentioned this already, you're less prone to panic. You don't have to place a stop loss. If you've ever come to any of my webinars before, you know that I'm not a real big fan of stop losses. I've seen too many times the stop get hit right before the market goes in the desired direction. It happens like clockwork. So I tend to recommend, if you're trading a full-size contract or the mini, you should probably have an option hedge instead of a stop. If you are going to trade without any stops, maybe the micro is a much better way to go. You can ride the waves and you're more likely to stay in the trade and have a chance to recover. Lasting power, I cannot say enough about lasting power. Traders tend to think in the short run and they think day to day, and so when they're taking some heat on a trade or something's not going exactly their way, the human tendency is to panic and get out. But like I had mentioned before, that's generally not always the right move. So the minis just kind of put you in a mental state where you don't have to make those stressful decisions. You can make hopefully more logical decisions. Also, you're not going to see as much account volatility. People that are trading minis, I see their account double, triple, quadruple in a few days, and then I see them blow out their account a few days later. That's no way to live. Nobody wants to manage those types of ins and outs in the markets. Less account volatility is good. It's not exciting when you're winning, but it's a heck of a lot less painful when you're losing. I'm a big believer that trading is 99.9% mental. If you can keep your wits about you, you're already a step ahead of generally almost everybody else. Trading the micros is exactly what that does. It helps you avoid emotional turmoil. And if you're not stressed out, you're going to make better decisions. And I know this is true because I talk to people all the time that are paper trading, and they make tons and tons and tons of money, monopoly money in their paper trading accounts, and they think they're the greatest trader of all time. And as soon as they go live, the exact opposite happens. And the only difference is emotion. Emotion is a huge part of whether or not we make or lose money. So if trading the micros sounds extremely boring to you, it just feels like it's not going to be exciting enough to keep you interested, I totally understand that. However, at very minimum, you can use them to paper trade. So if you have a new strategy or a new idea that you want to test, but you want to test it in real time, and you want to test it in an account that you have a little bit of skin in the game, not just a paper trading account, which, like I said, it eliminates all the emotions, trading with the micros is a really great way to test out a strategy. And until now, futures traders really didn't think of long-term trades. When they were trading the E-mini S&P, they were probably using 10-minute charts or hour charts or daily charts if they're swing trading. But buying or selling an S&P and with the idea of holding on for a couple of months probably wasn't in very many people's minds. But now with the micros, you can do just that. You can buy or sell, and you can hold them comfortably looking for a long-term move. So everybody has a everyone has a different opinion and a different personality. And the thing about trading is you want to make sure you are trading in a way that goes along with your personality. If you're trading against your personality, you're going to ruffle your own feathers and you're going to make bad decisions. I personally, the way my brain works is I prefer swing trading. In markets that are not necessarily trending, it works really well. When the markets are trending, kind of like what we're seeing in the S&P, it doesn't work so well. But that's with any strategy. Strategies go through good times and bad times. So you have to just kind of decide what market condition you want your good times to be in. So before the micro contracts, it would take a pretty substantial amount of fortitude to swing trade the E-mini S&P in a small account because you don't have a lot of room for error. And when I'm talking about swing trading, I'm talking basically buying the rips and selling, buying the dips and selling the rips. It's really hard to buy into support or sell into resistance with a regular E-mini contract unless you have some sort of option hedge to protect you. Because as we all know, as swing traders or trend traders, if a market's trading in a range, it's going to hold that range most of the time, maybe 80%. But on the rare occasions that it breaks out of that range, you could see some really substantial moves in a small amount of time. So being on the wrong side of that could be pretty detrimental, which is why swing trading in their full-size S&P is a really rough game. But if you're using the micros, you can be a little more aggressive in your timing. You don't have to wait for trends to confirm. You can simply buy into support and sell into resistance and be relatively comfortable doing that, knowing if it does break through and you happen to be on the wrong side, hopefully it's not going to be too painful. Now remember, the S&P, you're making or losing $5 a point. So the S&P on average probably goes up I should have said up or down, but I guess saying goes up 5 to 10 points is appropriate in the current market. But normally 5, 10, 15 points is the trading range on an S&P. So on a 5-point day, you're making or losing $25. On a 10-point day, you're making or losing $50. So as you can see, you're not going to get rich with this sort of thing, but you can get aggressive in your timing and you can actually put a swing trading strategy together that you can be comfortable implementing and you're not going to stress yourself out. It used to be only large accounts could do this sort of trading because only large accounts had deep enough pockets to write it out if something went wrong. So this is just to give you an idea of what you could do with a micro contract that you probably would have never dreamed to try to do with a full size because of the risks involved. This is a 1-hour chart, by the way, so each price bar represents 60 minutes. And you can see this spans, let's see, this is about 2 weeks, maybe 3 weeks. So this is a little deceiving. It seems like it's a long period of time, but it's actually probably about 2 weeks or so, 2.5 weeks. But you can see, if you look at on 60-minute bars, you can see that the S&P is definitely trading in ranges. I think we can, if we're honest with ourselves, we can all say we probably wouldn't have, let me get a cursor here. So we probably wouldn't have had the guts to sell. At this time, this was an all-time high in the S&P. That high has been broken and we've gone much higher now. But at this time, this was an all-time high. So you may not have been willing to sell an E-mini S&P that represents roughly $160,000 worth of stock going into the close. But if you were trading micros, you might have been willing to do that. It's only $16,000 worth of stock. If it goes up, you're only losing $10 a point. If it goes down, we all know the S&P goes down faster than it goes up. So you stand to make a little bit of money. Again, as every time the market comes down and tests these support lines, as a micro trader, you might be comfortable and go ahead and buying into the dips. That's exactly what the market generally does. It usually dips down to support and rebounds hard, but in the heat of the moment, it's really hard to do that with a full-size contract, especially knowing if you're going in on a full-size contract, you're either going to have to pay up in premium to protect yourself, just in case it keeps falling, or you're going to have to place a stop order. And we know how stops go. They generally get hit. And they generally get hit at the worst time. So you don't want to be stopped out and watching the market go without you. Just to give you an idea of this trading range, it starts out at about $200, so from high to low is roughly 200. And these, I'd say each peak and valley is probably taken place in consecutive sessions. So if you sold the high in one session and you bought back on the dip the next session, that's probably what you're looking at, is like a $200 swing up in this area. As the range expands, it gets into the $300–400 range. Over here, we're talking about in the $400 moves. So you can, even though it's a micro contract and it's smaller and it's a lot less stressful, if you happen to time it right, and I'm not saying it's going to be super easy to buy all the highs and sell, I'm sorry, buy all the lows and sell all the highs. I'm not saying that. I'm just giving you an idea of how you can implement a swing trading strategy, still have some profit potential, and not have a lot of risk. So let's see what happens when suddenly the support areas don't hold. Obviously, it held here, and I'm not going off of just arbitrary lines. We're using a basic RSI as overbought and oversold down here. Not saying this is the greatest day trading system of all time, just giving it as an example. But generally speaking, RSI, I'm a big fan of RSI. Most of the time, if you're looking at RSI on a daily chart or a 60-minute chart, it usually works relatively well if you've got some patience. So with that said, on this particular buy, the RSI lined up, support lined up, but it didn't work, and that's going to happen. As a swing trader, you just have to understand, you're going to, like, swing traders face higher probability success rates than trend traders do. However, trend traders, although they're only making money on 20 or 30% of their trades, they're making a lot of money on those small percentage of winners. Swing traders are a little bit different. Swing traders are going to win a higher percentage of trades, but they're going to make less on each trade, and they're probably going to lose a decent chunk of change when they're wrong. And so this gives you an idea. In this particular instance, the market, kind of the floor fell out. But even in this situation, which I think we can all agree is a pretty big slide, just eyeballing it 40, 50 points rather quickly, not a whole lot of time to make changes there. The micro trader really is only down about a couple $100. If you were trading a full size contract, you would have been down 2,000, and you probably would have been experiencing some stress. But with a micro, you're down 200. You may have even thought of adding on, or who knows what you would have done, but $200 isn't going to take food off your table. So that's the goal. That's the idea of these products. You can implement strategies that used to only be available or at least feasible for bigger traders. Now you can do it in small accounts. Okay, so another thing you can do with the micros is you can use them to hedge. And the funny thing is, when people think of futures markets, they think of risk, but the futures markets were actually created to allow people to hedge. It's a venue for hedging. Most of us don't use it for that purpose, but that's what it was created for. Basically, futures contracts transfer risk from one party to the other. So people that are hedging can transfer their risk to speculators. Buying or selling futures contracts is a zero-sum game. There's always going to be one winner. There's always going to be one loser. This is ignoring transaction costs and that sort of thing. So when a hedger is winning in the futures market, the speculator is losing, and vice versa. The idea of a hedge is it's the practice of taking the opposite position in a correlated asset to mitigate price volatility. So for example, we just discussed that a micro S&P is currently worth about $16,500. I mean, it fluctuates, but just to give you an idea, if you had exactly $16,500 in SPY or some other stock index that mimics the S&P, you could sell a micro future and it would exactly hedge your risk in the stock market. So for example, if you sold the future and you were long $16,000 worth of stock and the market went up, you would be losing on your futures position, but making on your stocks and vice versa. And as the market fluctuated, you basically wouldn't be making or losing anything, but you would still be earning dividends on your stock account. So that's the idea of a hedge. That would be a perfect hedge. Most of the time, I mean, to be honest, a perfect hedge doesn't exist in practice. It's more of a theoretical example because you're probably never going to be long the same amount of stock to match exactly what the futures contract size is. There's going to be slippage. There's going to be all kinds of different little things. But the reality is you can put on a pretty good hedge, and it can hedge most of your risk. In my opinion, you don't really want to have a perfect hedge, and most of the time you don't want to have a very sharp hedge anyway. You want to hedge part of your portfolio possibly, but not all of it. This is my opinion. Everybody has different opinions, but I believe you should hedge more when the stock market's high. So for right now, I think this is a great time to be hedging very aggressively. But if you would have asked me in December of 2018 when the market was dipping, I would have said, this is not the time to be hedging. That's the time to be taking hedges off. So it's not like this, the idea of hedging should be practiced the same way across the board. You have to adjust to market conditions. Now, to be 100% fair, if you would have asked me 2 months ago, I still would have said you should be aggressively hedging, and guess what? The market's continued to go up. So when you're hedging, there's definitely some speculation involved, which is ironic because that's the opposite of what you're doing or you're supposed to be doing. But the reality is, as a hedger, you are speculating. You're putting on hedges when you need them, not when you think you need them. As humans, we think we need them after the market's already corrected, but we actually need them before the market corrects. So let's take, for example, in this slide, actually, I didn't update it for the new S&P value. This is assuming that the S&P is somewhere around 2,800, I assume, with a value of $14,000 in notional value, but you get the idea. I'm going to adjust it to 160,000 for a mini contract and 16,000 for a micro, just to give you a more realistic example. But let's say that you had $160,000 worth of stock in your stock account. If you wanted to hedge all 160,000, you could do 10 minis, or you could do 10 micros. Sorry about that. It's hard to sometimes get them. So you could hedge with 10 micros. You could sell 10 micro futures, which I wouldn't recommend. You're better off just selling 2 minis instead, but that's a whole other story. Or you could also, if you have various exposure, let's say you happen to have 4 mutual funds in your account, and one of them is based on the S&P, one's based on the Russell, one's based on NASDAQ, one's based on Dow. I mean, I know this is kind of an imaginary situation. You're probably not going to have that exact portfolio allocation, but let's say you did. You could actually sell 1 micro of each to hedge your roughly $150,000, $160,000 account. So if you really wanted a full hedge on, you could sell 1 micro of each of those indices. I'm not saying you should ever do that. I'm just trying to give you an idea of how it might work, so you can apply it to your own risk tolerances and your own ideas on how aggressive you want your hedge to be. But this is just kind of another example. If you had a $200,000 account, you could hedge most of your risk almost precisely, like with a scalpel, by utilizing the micro futures. Again, you don't always want to have a full hedge on. Right now, it seems like a great idea because the market's overpriced, right? So even if you put a full hedge on, you're still going to earn dividends in your stock account while you have your price risk hedged. Now, you're going to get frustrated if you put a hedge on and the market keeps going up because you're giving up gains in your overall portfolio. You're making in your stocks, you're losing on your futures, and they're washing each other out. And, I mean, let's be honest, the stock market goes up almost all the time. It goes up more than it goes down. So you rarely want to have a full hedge on. Most of the time, you might want to have no hedge on or a small hedge. But when things are lofty, I think it's a good idea to hedge. And again, that's my opinion. Everybody has different opinions on this sort of thing. But if you do decide to hedge your portfolio, I want you to understand that timing absolutely matters. We are hedging, but we're also speculating with our hedges. You should hedge when you can, not when you must. Again, when the market's high. And even further, if you hedge and the market falls, but you never lock in your gain on the hedge, you didn't do anything other than pay a couple transaction costs and waste your own time and waste your own resources. So if you do hedge your portfolio and you happen to catch a correction, and what I mean by that is, let's say that you hedge your stocks absolutely. So let's just assume you had $16,000 worth of stock in your account, you sell one micro S&P, so you're fully hedged. Let's say the S&P drops 300 points. At that time, you are making about $1,500 in your futures account, but you've given up $1,500 in your stock account. So they've washed each other out, but that's exactly what you were trying to do. You were eliminating your price risk. You did it. But if you don't take the profit in the futures account and the market rallies all the way back up, you really didn't do yourself any good, right? You're not any better off than you were before the hedge, only you had to take money out of your stock account to put in your futures account. To implement the hedge, you had to pay some transaction costs. You had to spend some time on it, so you wasted your own time and resources if you didn't take a profit on your hedge. Now, most people will argue, if you take a profit on your hedge, then now suddenly you're naked and you don't have any hedge at all, and that's absolutely true. However, you're still better off, even if the market continues another 10 or 20% lower, if you locked in 10 to 15% on your hedge and the market keeps going lower, you're still better off than most people, and you're still better off than you were had you not had any hedge at all. So you have to look at it that way. You have to be an optimist. So I'm going back to that example from 2018 when the S&P dropped from October through December, through Christmas Eve. Had somebody hedged their portfolio at the exact right time, they would have made $3,000 on their hedge and lost $3,000 in their stock account, correct? If they had a perfect hedge on. However, if it was never taken off, here, I'm going to get my highlighter again. So if this person put on a perfect hedge but never took it off, eventually he broke even. So he missed out on all of these gains. Now, I'm not saying again, buying the low and selling the high is not something that's easy to do. I'm not insinuating that it is. Let's assume that the hedger takes off here. So let's say that he picks up, that's about 300 points in the S&P, so that's $1,500. So he hedged half of the correction. And the market rallied and he thought he was a genius and everything was going great, and then suddenly it falls apart again. But even though he's naked from here on out, he still hedged 300 points of that S&P drop, and it dropped a total of 600 points. So he was still 300 points better off taking a profit on his hedge than he would have been if he just left everything alone. Now, it's really hard to do that because as the world is falling apart, CNBC is running market on turmoil specials, everyone acts like the world's coming to an end. So it's really hard to take a profit on your hedge, but that's exactly what you have to do at some point. And you don't have to do it all at once. So if you're hedging $100,000 worth of stock and you have 2 or 3 micro S&Ps hedging, you can peel one off, do it incrementally. You don't have to do it all at once. And that's the beauty of the micros, is scaling in and scaling out. You don't have to have all in or all out. You can do it a little at a time. So something that a lot of people don't think of is you can use the micros to hedge your options. So we tend to do a lot of option trading. We have a lot of option sellers at our brokerage. That's kind of what we specialize in. If you're an option seller, you know that there's a few ways to hedge your position. You can buy options to hedge your risk or to cap your risk, or you can buy or sell futures against your options. But if you're trading a small account and you're selling 1 or 2 lots, buying a mini future against your 1 or 2 lot options can be pretty risky because a lot of times you can end up losing more on the future than you ever could have made on the short options. However, a way to combat that is to use the micros. The micro is 1/10 the size of the E-mini S&P. The E-mini S&P options are written against the mini, not the micro. So with that in mind, we can assume hopefully you're familiar with delta, but just as a reminder, delta is the rate of change in an option or a position relative to a change in futures price. So if you have an option that has a delta of 50% or 0.5, that means for every point the futures market moves, your option moves a half a point. So the futures itself, the E-mini S&P future, has a delta of 1. The E-micro has a delta of 0.1. So if you sold an option that had a delta of 50 or 0.5, and then you bought a micro against it. Let's say you sold a call and then you bought a micro against it. You lowered your delta by 0.1, so now your delta is 0.4. So you can see how you can manipulate your delta. A lot of people that are selling options aren't selling options with a delta of 50. They're selling options with a delta of 10, 20, 30, deeper out of the money options that they think are going to expire worthless. So this is a good way to get basically delta neutral and maybe even do a covered call or something. So let's look at an example of what you might, this is just a total random example, but to give you an idea of what you could do and how, hopefully you can become creative with this sort of thing. But prior to the micros, to try to delta neutral trade, you'd basically have to trade a full size or an E-mini S&P futures against the options, and it would require quite a bit of risk, to be honest. Now that we have micros, you can sell a deep out of the money call and go long a future and create a trade that has a relatively reasonable amount of risk and a decent profit potential and very little margin. So let's just, this is kind of a complicated subject to try to understand in one slide, but I'll try to do it. So let's say we go long a micro future near 2770, and then we sell a 2900 call with a delta of 15. So our delta is basically 0.5, or it's almost neutral. You're never going to be exactly neutral because the markets are always changing, and you don't want to, if you're always trying to chase neutral, you're just going to churn your account, to be honest. But this will give you a relatively neutral trade that makes money whether the market goes up, down, or sideways. You get to keep the $550 you collect for the 2900 call as long as the market's below 2900. You keep the entire $550. Now the E-micro future is going to make or lose point for point with the market right off the bat. But because you collected $550 on the full size contract, but now you're long a micro, that $550 is going to cushion you for about 110 points in the S&P. So the S&P can drop 110 points before expiration, and you just break even. You don't even lose. So you can be wrong by 110 points and just kind of call it a wash. If the market does creep higher, which this trade would be speculating that the market moves higher, but not over 2,900, if in a perfect world, the market's settled right at 2,900 at option expiration, you keep the $550 you collected on the call, and you keep the profit on the futures, which is, sorry, it's been a long day. My math is just off. So, which is about $650, and I guess I could have just read my own slide. So the profit potential is about $1,200 if the market's exactly at 2,900. Anybody that's ever traded options knows the market never settles right on a strike price, and it's especially not going to settle at the strike price that you need it to get your max profit. That's just not how the world doesn't work that way. But if it did, that would be the most you can make. But even if the S&P, even if you were right and the S&P rebounded 50 points or 100 points, you'd actually have a really nice trade on your hands with very little risk. Now, I should point out though, I told you there's 110 points in risk buffer underneath the market, but if there's no guarantees the market's going to hold there, it could just completely fall out of bed like it did in December, maybe even go back down to 2350, and you're going to be in some hot water. You'll be out probably $1,000, maybe 1,500 if it gets really, really ugly. So, but even then, I don't think, it would be unpleasant, don't get me wrong, but it's not going to be nearly as treacherous as it would have been if you tried to do something similar using an E-mini instead of a micro. So in conclusion, if you're looking to speculate with lower risk, less stress, and better odds of success, and I say that because you're giving yourself more room for error, and you're also taking a lot of the emotion out of it. So I do believe trading with the micros is going to give you better odds of success. Micros might be the answer. Those that are looking to hedge a portfolio or to manage risk and or avoid a taxable event. And let me explain that. I should have explained that a little better, especially this year. If you were a stockholder sitting on huge capital gains, but you didn't want to pay taxes in 2018, you wanted to wait to pay taxes at some point in 2019 on them, you wouldn't want to sell your stock, but you could do almost the same thing by selling futures contracts against it. So you eliminate all your price risk. You're still earning the dividends. You did not create a capital gains event, so you're still pushing your taxes into the next year while getting the best of all worlds. So hopefully you learned something out of today's class. If you are interested in learning futures and options, please visit our website, DeCarleyTrading.com. There's a lot of free educational material, videos, and articles, and we'd love to hear from you. If you're interested in learning more about covered calls and analyzing markets and those sorts of things, Higher Probability Commodity Trading and a Trader's First Book on Commodities is available at any major bookstore, but Amazon is generally the cheapest and quickest. And if there's anything I could do for you or you have any questions, please feel free to contact me. Here's my information.
Okay, if you have any questions, please type them in and I'll ask them to Carley. There is a question on when do you think we'll see a micro crude?
I believe it's going to be this year. I've actually talked to them about them. When I say them, I'm talking about the CME and the retail department. It's on their radar. It's in the works, and I don't know for sure. I'm just kind of speculating, but I believe it'll be this year, and I really hope so because that would be a great product.
Nice. All right, I'll give them a minute or two to put their questions in. If you're watching later on YouTube, you can email Carley at her email there and ask her directly. Okay, I think that's it. I'm not seeing any questions. Thank you for the webinar, the information, and for spending some time with us this evening.
Thank you.